And as far as the global economy goes right now, things looking pretty dismal. We've had a month of market turmoil, Europe's debt problems refusing to go away, and world leaders seem unable to do anything about it. So where should we be looking for inspiration? Well, UBS Investment Bank's George Magnus has one unlikely suggestion. Karl Marx, he says, as soon as policymakers realize we're facing a once-in-a-lifetime crisis of capitalism, well, the better equipped they'll be to find a way out of it. So what can we learn from Marx? Well, he once wrote, the ultimate reason of all real crises always remains the poverty and restricted consumption of the masses. A statement that Magnus says is as relevant today as many of Marx's other predictions. Not convinced? Well, George Magnus is here now to talk us through his thinking on this. Great to have you in the studio with us. Thanks. So was Marx right after all?
Well, I mean, I think as by now, we know very well that he wasn't right, and actually his predictions about what would happen to the capitalist system proved way off the mark. But his analysis of how the capitalist system works actually bears some very uncanny likenesses to what we see going on today. The credit boom, the bust, the revelation of inequality, the kind of full exposure of how weak our labor markets are, the lack of growth drivers. I mean, all of these things actually are very Marxist, if you want to put it that way, in terms of the diagnosis of what ails us today.
So what does this mean? Capitalism has to essentially reinvent itself?
Well, I think
in some sense,
in some respects, but I don't think we have to kind of find, and scratch our heads for solutions that haven't been provided before, because, of course, in the 1930s, capitalism went through another and very, very serious credit boom, bust, and John Maynard Keynes basically articulated for us how capitalism can save itself. So, as Homer Simpson would say, Doyle, what's the problem? Why don't we just kind of try and follow some of those examples again?
Okay, well, Homer Simpson aside, George, just want to go through your prescription for the problems that you outline there and actually speak about step one being employment creation. Governments not facing an imminent debt crisis should make that their priority. Step two, alleviate household debt burdens, help borrowers get their payments down, perhaps through some restructuring of mortgage debt. Next, improve credit lines, give some banks temporary capital relief so they can get the cash flowing to companies, and then address Europe's debt burden, get creditors to essentially offer lower rates, longer payment terms, like those that we've seen for Greece, and finally, defend against deflation and stagnation by targeting growth. So a range of points there, and George, as you say, these are challenges that we've spoken about many times before. How do policymakers manage the current crisis? What should be their absolute priority right now?
Well, I think personally, of all of these steps, obviously some of them are politically, the time for these things hasn't arrived yet, and things may have to get worse before policymakers will embrace them. But I think that employment is, above all, and should be the litmus test of everything that governments, think about and do. So, cutting taxes, if that's what people would like to do, top rates of tax or whatever, value-added tax. These things, I think, won't really work because in a household deleveraging, people will simply use the extra money to either pay off their credit cards, put down payments off against mortgage debt and so on. So what you really need is you need to keep growth going. And the only way you can do that is by widening the employment base, because more people at work means more income, more tax revenues, more consumption. And we need to do things that will encourage private sector job creation.
All right, so how do you go about that more specifically? We just had Eurozone data coming in, unemployment inching up towards 10%. It's not getting any better. What are they doing wrong?
Well, I think what needs to happen is, particularly when the government, rightly or wrongly, has taken upon itself, the job of austerity. And, people say there's no alternative. Maybe no alternative in Greece and Ireland, but there is an alternative in Germany, for example. But if governments aren't going to be able to, or don't feel that they can really, embark on public spending programs for one reason or another, you can cut payroll taxes, for companies, particularly for small small companies, which are the backbone of employment creation. It's not big listed companies that do this. So cutting employment taxes, creating special kind of zones where companies get fiscal incentives to invest and recruit people. I mean, I'm not saying that these things are going to magically work overnight, but actually the alternative is also not acceptable.
And it doesn't seem to be working right now, because one thing we often talk about is the fact that many companies have all this cash just sitting on their balance sheets. So how do you get them to essentially invest and hire when growth is still so weak?
Right. So listed companies have a lot of cash on the balance sheets. Small and medium-sized enterprises that aren't necessarily, quoted on the stock markets, actually not quite so good. If you look at small business surveys in the US, the National Federation of Independent Businesses, these companies are still finding it really, really tough, largely because they can't get credit. But big companies with cash won't spend it, basically because they have rather gloomy views about what's going on in the world. So if you think about now is the time when most or a lot of big companies will be thinking about their capital budgets for 2012. Why would they feel optimistic about raising their capital spending? No reason at all.
So what could be done then to help those smaller businesses which are having a tough time getting a line of credit?
Well, there may be a case, this is quite controversial as you've reported in packages just now in the UK, there may be a case for saying that you could slow down the rate at which well-capitalized banks or strong banks have to fulfill their obligations or new obligations on capital ratios to try and get them to kind of spend a little bit more. But, governments and central banks can do direct lending as well. This doesn't have to be solely private sector banks which are themselves trying to shrink their balance sheets. You could get public sector agencies and governments to basically make loans, particularly if it's a loan for an investment in the future. I mean, it's not a wasted investment, it'll be self-financing. These are controversial measures, I'm under no illusion about that. But we must recognize that the private sector, the sea legs of the private sector are very weak.
And you were saying that much of the volatility that we've seen over the past month seems to come down to this crisis of confidence in both the US and Europe, this lack of confidence that policymakers can essentially deal with the challenges that are ahead of them. You said that there are still serious political challenges ahead, that things are going to have to get a lot worse before they get better. Can you be a bit more specific about what that is going to mean and how that's going to feel for people?
Well, just two little examples, really. I mean, obviously, a lot of the focus at the moment is, are we going to go back into recession or, back into another contraction? I mean, my view is that we never left the first one. I mean, it's still with us. We just had a bit of a bungee jump out of the abyss, but we're still in a very, very serious position. And I think that if we do have faltering growth or negative growth over the next 2 or 3 quarters, obviously unemployment numbers, labour market data will get worse, and there'll be a lot of pressure on governments to respond.
Just a very quick one. If it had to come down to one thing in Europe, is it simple to say, well, it's all down to Germany and Europe, and in the US, well, Barack Obama has to do more on this fiscal side, job creation programs and investment? Is it as simple as that?
You don't like to make it that simple, but it probably is. With the rider that I think in Europe, bank recapitalization is absolutely an essential thing that the Europeans must do, but they don't seem to want to talk about it.
Great to have you with us. Thanks so much, George Magnus, Senior Economic Advisor at UBS.
Thank you.